Introducing Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt 2AM. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. He's speaking to us from Alabama. Welcome back to the show, Tim, and thanks so much that the hurricane missed you this time.
Oh, thank you. You hate to wish that on someone else, and I don't. I don't. I'm just glad it didn't come here. It sounds horrible to say that. You don't wish something like that on anyone, but you're at the same time, you're like I said, you're glad it didn't hit you. We sat through one a couple of years ago, and one every few years is enough for anybody.
Yeah, once in a lifetime is one too many.
Exactly.
Tim, back in January, you felt we had the top in the equity markets. It's declined into September, just as you said it would. But now we're in October. Where do you think the stock markets are going to go?
Well, we're bouncing out of, what it's certainly a short-term low in my world, something I call a trading cycle. It may be an intermediate degree low. I don't know yet. We're approaching some timing for an intermediate degree bounce. But, based on the data and the evidence of the higher degree 4-year cycle top, started to see that. Actually, if I could digress for a minute, back in June of 21, I saw a unique marker that warned of the 4-year cycle top. And not all 4-year cycle tops have this warning, this marker, if you will, but this marker has, when it has occurred, it has always been with in association with a 4-year top. And so I saw that last June of 21. And it also, the statistics surrounding that said that every time that had occurred, the 4-year cycle top that followed had occurred within 6 to 8 months. So that told us that somewhere around that January, February time frame, we should expect the 4-year top, and that's exactly what we got. And so with that said, additional evidence developed, and I followed that and covered that in the research letters along the way, and telling us that we had the 4-year top. And I think that, nothing's changed there. I think we've got the 4-year top, and we've had, obviously, the market was a little oversold. We've had a rally, and, I think it's counter trend. How we progress from here is something we're monitoring in the, short-term updates and letters, but I think it's counter trend, and that we go further down into the 4-year cycle low, which is ahead of us.
Of course, the timing of that, when does that low hit? Because so many people, there's kind of two theories floating around right now that I'm hearing from so many people. It's either November, look out, as the wreck of the Edmund Fitzgerald warned, when the storms of November come early, it's never good. And that's when the markets could really take a giant dip. Or they're going to hold off and hold on, because with an election just around the corner, the government does its very best to prop things up and tries to make the market look good. Then after the election's over, they know they can relax for another year and a half before they have to worry about the markets and elections again. And that means sometime in the spring, we could see a major collapse of the equity market. So a long way short, does the pain happen soon, or does it happen next year?
Well, it doesn't, with regard to the 4-year cycle, it doesn't matter if we bounce here going into the election or not. It should be counter trend, because what I'm looking for, what you're talking about in my world would be like an intermediate degree low going into the election. Do we hold up here? We may. I don't know. There's an awful lot of people calling for a crash right here in October. And, I don't like the company with that. I don't know if that's going to develop or not, but, we do have the 4-year cycle top. We are set up for greater weakness in the grander scheme, but we're also, like I said, was oversold, and we're at, or approaching an intermediate term low. Whether that occurs right here ahead of this election or not, I'm not sure yet. But that said, my point is that the 4-year low I'm looking for, the big low I'm looking for, is not going to occur here or the spring. I mean, that's still well ahead. I'm not looking for that higher degree low until late 23 or early 24. So anything along the way here is, like I said, it's just counter trend. So that longer term low is ahead of us.
Now, of course, the next thing is, if we can't time it precisely, how much of a dip are we looking at?
Well, let me answer the question this way. When I get an intermediate term buy or sell signal, it tells me. And so I can look at the timing and say, okay, I expect a low based on statistical norms of the timing bands, and say I'm looking for a low in this time frame. And so that gives me guidance, if you will. That's my target window. But then within that, I have to see the buy or sell signal, whichever I'm looking for. So at this point, there is a window out there in October, runs into early December, where I'm looking for that intermediate term degree low. Did we see it slightly early? Did we see it a couple days early on September the 30th? Or is that low still ahead? I don't know that yet until I actually get my intermediate term buy signal to tell me that low in the oscillator picture in association with that buy signal tells me that the low is in place. So I'm not trying to avoid giving an answer. I'm saying I got to see the signal. We're approaching the early side of the timing band for such a low. So, when that signal occurs, we got the low. I don't know when that's going to be, but again, we're in the timing band. Could we, it could go either way. Looking at that timing band, we could bounce here and get a good, if I get a buy signal. I mean, we're at the early, like I said, I don't mean to repeat myself, we're at the early side of it, so we're kind of in the zone. It's a little early, but we're in the zone, so to speak. So we could get a rally here, and all this talk of the crash into October could be, kind of futile, which is, it like I said, the company, with everybody talking about that, concerns me. So, typically most people don't, you don't hear that. It comes unexpected. So the fact that we're hearing that is somewhat of a warning to me. But at the same time, maybe we do. And if we don't get an intermediate, if I don't get a buy signal here, we could certainly go down into that time frame. So again, that buy signal or the current sell signal is what is going to guide me. And that's, something of course I'm covering in the short-term updates.
We'll have more with Tim Cyclesman Wood right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, what's your outlook on crude right now?
Crude oil, counter trend. I think the 4-year cycle, in commodities is a 3-year cycle. I started seeing the evidence of that setting up in late spring, early summer, in April, May. And I'm sticking to my guns on that. I think the higher degree 3-year cycle has turned down in commodities. And I think, just like I said with equities, I think any bounce here is counter trend.
Now, of course, affecting crude, we have OPEC plus, Russia trying to get around sanctions and so on, and then producers here not getting any encouragement from the government in terms of tax breaks or so on for exploration. For the oil companies, is it not, now that they're saying we don't want your oil, can we expect $10 a gallon oil to be a continuous thing in the future? Here in Vancouver, we're paying $10 a gallon, roughly.
Well, let me ask you this. Has the price of gasoline not come down in the last few weeks, months?
Not in Vancouver, not on the West Coast. They shut down the refineries, quote, for maintenance. So No, we're paying the highest gasoline prices in North America. $2.42 a liter, something like that. $9.68 Canadian a gallon.
Well, do you realize? Let me drop something on you that you may not realize, but you guys are getting screwed because, and I don't know who's doing the screw, and you can figure that out. But crude oil, gasoline peaked in June, and it's off. Well, it peaked at. I'm looking at a chart for this chart says 433. And we have been as low as, and that's $4.33 a gallon. We've been as low as $2.31 a gallon. So it's roughly 50% decline. In round numbers in crude. I said crude oil in gasoline. We closed yesterday. I don't know what it's doing today. We closed yesterday at $2.52. The rule of thumb in my area is you can look at the spot price, which is, again, as of yesterday's close, was $2.52, and add 60 cents to it, and that's what you should pay at the pump when prices have stabilized. Something's moving up or down. They especially if it's moving up, they'll tend to move prices quicker at the gas pump than they do moving them down. But once prices have kind of stabilized, the rule of thumb in this area is 60 cents spot plus 60 cents. And that's about what it is. It's around 309 here on average at the pump. So we're real close to that rule of thumb. So if you guys have not seen a decline in the price of gasoline, it's not because it hasn't come down, because it has.
I was going to say it's like dropping the soap in a prison shower.
Yes. Yeah. Somebody has slipped you the weenie.
Yeah. Now, gold.
You may want to cut that out.
I don't know. No. Because I'm telling you, at least I expected dinner in a movie. Now, gold, should it be stronger than it is right now? Or because people are saying you can't have gold and the U.S. dollar go up at the same time. Is that really true?
Well, obviously not. Or obviously it is. I mean, you can't have them both go up at the same time. But, it doesn't mean that the cycles are moving. It could be counter-trend moves. And what I'm saying here is the 9-year cycle topping gold is in. We've been saying that. We saw the retest of that high back in March. And I think, like everything else, just like commodities, just like we talked about crude oil, just like with equities, I think what we're seeing here with gold is another counter-trend move. I do think there's some higher degree lows, a better bounce coming, but I think this current bounce we're seeing here with gold is counter trend.
The Bank of Canada Governor Miff Macklin, sounds like a made-up hockey name from the 1930s. Anyway, he says his goal with hiking interest rates isn't to bleed the Canadian economy into submission and cause high unemployment. Now, that may not be his goal, but frankly, interest rates are a pretty crude, blunt instrument to control the economy, are they not?
Correct.
Yeah.
And I think that this, there's been some strange stuff with this entire interest rate hiking cycle. And, it's from, again, in my world, you data mine and you look at data and you find common denominators. And, to have seen the rate hikes that we've seen in the environment that we're in, given some of the very rare readings with my Fed model, it doesn't make sense. And so this is strictly being, how do I say, I think it's somewhat of a synthetic rate hiking cycle. And why that's happening, I don't know. I mean, everybody can speculate on that to their own, but it is detrimental, and I think it is going to. I'm surprised this market's been able to stand it as well as it has, by the way. But I do think that it's going to have its repercussions, and I don't know how much longer this rate hiking cycle can continue. But to give you an example, back in February, and I talked about this before, I have seen a marker, I don't know how to describe it, an occurrence, a thing, a DNA marker, whatever, a phenomenon that has only been seen at rate hiking, at the top of rate hiking cycles. and to have seen this occur at the bottom of a rate cutting cycle, or the beginning of before a rate hike ever even began, it's unprecedented. And then to see them continue to raise into that, it tells you that you're in somewhat of a unique environment, and it doesn't mean by any means that occurrence is not valid, because it's valid as it can be. I mean, it has a track record, a history. It's as valid as it can be. The fact that they have raised into this is the phenomena. And again, I think that the key is with interest rates, and I do think there's a peak out there. I think they have jawboned rates higher, and so far the market has bought that. But once that turn occurs, I think it's not going to be the positive thing that people think it's going to be. Now, initially, I do think that if the Fed, once they pivot, so to speak, it probably will be perceived as a positive occurrence, saying, oh, the Fed's now they're accommodative all of a sudden. But that's not the case. Once interest rates turn, I think it's going to be a big problem.
How high do you think they're going to go with their central rate?
I don't know that. Again, I have to look at the data as the data is given to me. I have a model, and I use the T-bill rate and the Fed's the discount rate, and there is a relationship there and some stuff that I'm looking for, and typically there's a typical spread between the two, and there's some commonalities. Then once the market, let me answer the question this way. I don't know the answer. I'll know it when I see it. But once the Treasury market stops buying the higher interest rate narrative, and it will. I don't know if you remember, or if maybe some of the listeners may remember, back in December of 2018, the Fed was talking rates up, and then all of a sudden, the market, and it bought it for a little while, and then the market said, nope, and they did an about face, and then all of a sudden the Fed turns dovish. And that was a big thing in late 2018 and early 2019. And that's the sort of thing that I see out there. At some point, interest rates are going to say, nope, the cycle's going to turn, and then I'll see it in the Fed model, and that's it. That's it. They're going to do their pivot at that point. And when that is, I don't know. I mean, can this market withstand another 25 basis points, another 50 basis points? I don't know. But I can say this, something else I'm following. As we approach the next Fed meeting, that model is going to give me a good idea of whether they will raise or hike, or by how much. And so far what they've been doing is an incremental hike. It sounds like on the one hand that they have been very, very aggressive. We've seen some 75-point rate. I think the last two have been 75. I think there was a 25, a 50, and two 75s, if I remember right off the top of my head. And each time, 75 is obviously pretty darn aggressive, but actually when I look at the model, they haven't been aggressive. They've just eased them up according to the model. They've done the bare minimum they've had to do to get rates back in check. And then what they've done at the same time is they've continued to jawbone and say, we're going to continue to push rates higher. We're going to continue to be tough on inflation and all this stuff. And so they've sold the market the narrative that they're going to continue to raise rates. And at some point, what I'm saying is the market's not going to buy that. The Fed model will show it, and they will stop.
Tim, anything else that we should be keeping a close eye on right now?
No, I think interest rates is key. I think, we're seeing some unique stuff in the dollar. It's not just interest rates that is unique. It's not just, commodities. It's all of it. And to give you an example, we talked about this a little bit before, but I'll mention it again. We've seen, let me say this another way. I just mentioned, talking about the unique things, you're making me think how I want to present this. I talked about the signaling of the beginning of the end of a rate hiking cycle that normally occurs at the top of a rate hiking cycle. We saw it before the first hike ever began. That's unique. Another unique thing about the environment we're in is that this is the longest, one of the longest cyclical advances of the dollar in history. And, with the dollar, there's a 4-year cycle. That cycle is not stretched beyond belief, but there's a shorter term, like an annual cycle, and it's the longest annual cycle within that 4-year cycle advance in the history of the dollar index. That's unique. Another unique thing that has occurred here is that while we've seen the longest advancing annual cycle of the dollar, we simultaneously saw into the high in commodities, and whenever the CRB peaked in June, I think it was, I'm not looking at a chart right now, we saw the longest or the highest percentage single advancing 3-year cycle in the history of the CRB going back to the early 70s. So we've seen a number of unique things here, and I think that, as I see it, the only way I can explain that uniqueness is it's a function of the environment we're in and the policies that we're seeing to push rates higher. And I think, like I said, that turn point is out there. When, I don't know until I see it. When I see the structure and see the pieces that I need to see fall in place, then I think we're going to be at a major inflection point. But anyway, that's pretty much it. I think interest rates and the dollar are just as key as everything else to watch.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You can find us on YouTube at Talk Digital Network, also on BitChute at Talk Digital Network. We're on Facebook. And if you have any questions for the show or our guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.